Welcome, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you today's Strategy of the Day update for September 8th, 2021. We're going to start today by talking about the soybean close. It was impressive to finish positive, particularly after yesterday's sweeping reversal and outside day to the downside. However, I don't trust this type of positive close because of that lower low and lower high that we did show on the day, and ultimately really a doji candle within 2 cents of it there. Not a great settlement price when all things are considered. Still at the low end of the range, and flagging down here suggests maybe some continuation lower. But remember, trading in futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. So let's take a look now. Test. Okay. Anyway, hopefully you guys can hear me. Let's take a look now at that daily chart that we've been looking at every day for the last few weeks. 18-day moving average at 1315. We're well below that area. The 1335 55-day moving average, still holding that as resistance on our last test up on it last week. The 100-day moving average at 1353 half seems to be rolling on over. And of course, the 200-day moving average is still, there it is, a little bit below us here, down at 1259 at this time. And of course, those lows from the month of June down at 1240, excuse me, and at 1260 there for the 200-day moving average, down at 1240 is that area of support and influence that we've been looking at. That trendline support that we drew from the June lows through the August low, we are and did close back below that level here today. We only spent 2 days kind of going back above or testing what to me is broken support, now is resistance, and we are starting to fade away below it. Next area of confluence and maybe congestion zone on the charts, I think is a bit lower here between the 1160 and $12 mark that we've been talking about. It's also that full 50% retracement comes in at 1155. And here is, we'll take a look here now on the 4-hour charts. We've looked at numerous times in the past, but the equal legs down, right? Measure from 1480 down to 1240, extend that from 1420, and of course our 1380 highs, that has 2 equal legs or 100% extensions down around 1183 and 1140 that we could be marching lower or could find our way down to. Now, no matter how you really slice up this market, we are still in a much larger wedge or range. It just seems to me that every single time we draw a trendline support on this chart, the market wants to break it, head below, and stay below that area for the time being. Trendline resistances still seem to be, at play, and the fact that we made lower lows and lower highs for both the month of August here relative to July, and are starting to do so here for September, is not a very bullish scenario starting to play out. Intraday, we had a big range on the day yesterday to start us off, really start the week's trading off with that move towards back above $13 for just a brief moment. The full 50% retracement from last week's high of 1340 down to that 1270 low comes in at 1304. Right into the resistance that we saw. So that the downward sloping trend line against the highs, as well as that Fibonacci 50% level, seems to be where we're finding that resistance. It also could align with that congestion zone we had and the support that we had from last Friday that we broke below 2 Fridays ago, I guess now. Well, it was last Friday, but not this. You guys know what I mean. And now have broken below last Monday, found it as resistance on Tuesday, and continued lower through the rest of that week. The 2-day bounce that we saw coming off of the lows of last week faded away pretty quickly here today and yesterday with that sweeping reversal from a 1305 high down to the lows that broke below last Friday's low at 1276. So that outside day to the downside, to me, has a little bit more confirmation of potential lower price action with today's close. The only thing I would have liked to have seen to really confirm that a little bit more is a negative close for the soybeans. But lower lows and lower highs on the day, and really being unable to put together, I guess being unable to sell off and in a fire sell, below the lows of the month was, of course, supportive and great. But that's about the only thing you can, bulls can rest their hat on at this time for the very meagerly positive close we saw today. So Trend line resistance against the high seems to have been holding there into the end of the day. Wouldn't be surprised to see this market trade back up to a 1288 to 1290 though, and find resistance in the overnight price action. Take out the stops above those highs, cause a little bit of pain to the sellers before rolling back over. A move down below 1270 now. We've got, call it a triple bottom. I don't believe in triple bottoms, although I guess there was a bit of a triple top formation here that you can't argue with back last week. But I worry that going through a level like this would accelerate to the downside. Just like if we rallied back up and got back above 1330 to 1335, the highs from last week, we could see some acceleration higher up to 1380. Lots of stops are going to be existing up there from the sellers. Well, very likely there's a lot of stops from our buyers over the last couple of weeks down below that 1270 level. And if we start to slip below there, there's not much of the way until our prior lows here at 1240 and below there down into that $11.50 to $12 inflection zone that we've been talking about for some time. So going down to the shorter time frame chart here, the 15-minute chart. Again, I want to make everyone aware, highs of this week so far and highs from the month of September at 1305.75 down to the lows of today. 50% retracement still around 1288. So wouldn't be, again, surprised to see a little bit of reaction up to there overnight before rolling back over. But certainly while we remain below this trend line, while we remain below the highs and the higher highs, our lower highs that we made throughout the day, this market is vulnerable for further decline. So let's keep an eye out on that. But we'll see if go ahead and throw a little box up here. We'll see if that continues. Now, something else is that when you draw this trendline support, I wanted to point out kind of the difference between time charts versus tick or range bound charts, range bar charts, which we'll look at in a second. Drawing this trend line against the lows, we just broke below that level yesterday and never really looked back. If you look at this chart in terms of a 233 tick or other form of range bar, draw that same trend line against the lows, and we actually retested it here in the overnight price action or yesterday's recovery rally into last night as resistance. So to me, this suggests that we've already had the broken trendline support tested as resistance and now could turn lower from this chart. Now, you draw that same trend line against the highs here today, and it looks like we broke above that trend line, tested as support already, and could be heading up again to that inflection zone I mentioned around 1288. But it's interesting how when you look at a chart versus range bars or a tick chart versus a time chart, those same trend lines drawn from the same peaks and valleys look dramatically different. And that's because of how time passed through some of these movements. So let's move on though. Again, I'm a little still pretty bearish on the beans here, and certainly bearish while we're below $13 at this time. We get above 13 bucks, break above trendline resistance, we could see a rally back towards the $13 area. But at this time, it seems like to me a market that's rolling over, even in the face of more bullish news like the 100,000 metric tons of flash sales we had to China this morning. Can't seem to be enough to get market excited about that demand. So the only other thing we need to do now is find lower price. So December corn, big inflection zone down around that 450 area, equal the open gap around 477 we'll be talking about. December corn seems to be coming down to test the 504 200-day moving average. We are below trendline support though, drawing from the May low through the July low. We did break below that level here, came in around lows from 2-3 days ago at 516. Now tested that as resistance here in today's candle, and with that negative close, even though it's minorly negative, it still seems like corn has a little bit more to the downside to go. We've had a bearish crossover of our 55-day, 100-day, and 18-day moving averages that corn held as resistance a week and a half ago. We're still heading lower from there, and trendline resistance against the highs still seems to be holding at this time. So let's look at that 4-hour chart for December corn. The full 50% retracement down around 497. Equal legs down that I mentioned could come in around 490. The open gap is still 477. And it does seem to me that two trend lines you could draw, or few trend lines you could draw on this chart, the supportive ones here, we're starting to break below. You also have now resistance trend lines that you can draw against the highs to continue to watch. One of them, and the most aggressive of which, drawn through the highs of late August there, through the highs that we made here into last week. We seem to have held that area as resistance too. But this, to me, December corn just looks like a market that is very content with continuing this trend that we started last week and continuing it lower. Well, really 2 weeks ago now, because that was at highs from last Friday. We ended up trading lower on the open and never really looking back, going back to a week and a half ago. So overnight, the 50% for the month of September, drawn from 536 highs to the lows, held as resistance there, the 526 area.
Yeah, or maybe get through the very 10 minutes.
We continued to flag that area for a few days there before finally breaking down. Let's look at our 15-minute chart now. Today's price action, we had a very impressive reversal off the lows of the day, but this was really just, to me, consolidation and a little bit of capitulation at a low that we're starting to roll over. We came and rallied right back up again to test that broken trend line support now as resistance, and also the lows that this market was forming from last Thursday. It's just a technical sell-off. Drawn from the highs of last week at 528 or into the end of last week from that consolidation down to the lows, the full 50% here seems to be the retracement level that we almost got to today, up around 518. But again, we had both trend line resistance and that 50% line, and now that broken trend line support now is resistance coming in from the chart. All reasons why we snapped back at 9 cents higher, found an area to reverse from, and started to roll back over. So again, I think the 200-day moving average down just below the lows of today seems like it's going to get tested. We start to go below there. What's stopping us from testing $5 or going below? Seems like December corn wants to test down towards that area, and we have the threat of filling that gap down around 477. We just can't ignore at this time. It's something I think we really need to be aware of. Okay, so moving on here, let's just take a quick look at December wheat. Give you an idea of where some of those larger time frame structures might, or moving averages might be, because we are coming down under the 18-day moving average at 734. Market's kind of rolled over there, coming down to test the 200, the 100-day and 55-day moving averages, which are around the $7 mark. We trade below there. 200-day moving average is around 667. And ultimately, we've been in a bigger range for wheat between the 760 and 620 area. So we could just be range trading and have a retest down towards the low sixes in the works. On the shorter time frame, however, we talked last week about just cleaning up the chart a little bit here so there isn't as much on it, and we can start talking about some of the levels. Okay, the 4-hour time frame, we talked about a little bit of a head and shoulders pattern. Left shoulder up into the 740 area, head at the 786, right shoulder formed around 740 again. Had that neckline that continues to be kind of the resistance in this chart at this time. Certainly flirted with trying to get above it here today, and it's for the start of September, or yesterday I should say, up to 733 high, but ultimately was holding a little bit of a retracted trend line here, and still seems to be a bit of a trend lower. Lower lows and lower highs now for the month of September against our August candle. Kind of feels like a big old reversal structure might be happening. So last week's strategy of the week update, I looked at the idea that the $7 area for put protection was probably pretty important for wheat traders. And I can't deny that it seems like that is a good place to still own some puts here for the market to potentially continue lower at this time. So we go below $7. It'll be nice to own those, and there's still some opportunity to get into those cheap. So we'll see what happens here going forward. But again, rather than selling futures here, I definitely think having the put protection on at that level makes sense, because I mean, at the very least, we're probably going to go down to test the 680 area, and then even below that, we'll head down to 640 or even below. So, with that being said, everybody, feel free to check out everything we have to offer here at Zaner. Want to always have the continuous discussions with you. I can be reached here at 312-277-0110. Find me on Twitter, find me on Facebook. Sign up in the links below to get our Zaner daily newsletter, where you can get our entire team's discussion of market price action. Or join me tomorrow at 2 p.m. for the Strategy of the Week webinar, where you can find links to sign up for the mailing list below. Have a great day, everybody, and I'll be back with you as price action develops. Take care, everyone.